One of the most fundamental decisions in a deal process is whether to structure the transaction as an asset or stock purchase. We will elaborate on the pros and cons of both momentarily, but first I thought I would emphasize why this is so important. Even by the entertainment standards of private equity training materials, this topic is dry. Incentive is necessary because you could be watching raccoons steal food from cats on YouTube, but instead we're going to be talking about taxes. Consider the following quotes. What is the difference between a taxidermist and a tax collector? The taxidermist takes only your skin. The hardest thing in the world to understand is the income tax. It is somewhat of a paradox that a topic so frequently discussed and reviled is generally found to be too boring to study, especially when you consider the lengths humans will go to for money. For the promise of a handsome six-figure salary straight out of college, a young 20-something will live in a cubicle and learn to use Excel without a mouse. I am very guilty of this. But comment that you can help someone grow their wealth with tax-efficient structures, and you've lost them. Fortunately, the world of efficient tax structures has its own superhero, John Malone. If you are unfamiliar with John Malone, the two most important things to know about him for the purpose of this lesson are as follows. First, he is an incredible investor. Few people have made more money for investors over the past 3 decades than John Malone. The billionaire cable TV investor and operator parlayed a small group of cable systems originally assembled in the 1970s into Telecommunications Inc. before selling it to AT&T in 1999 for $48 billion. And second, he is excellent at avoiding taxes. No other executive in the United States has mastered the intricacies of the tax code to the same extent that Malone has, says New York tax expert Robert Willens. We are consistently in awe of the structures he and his advisors come up with to rearrange his extensive holdings, always without tax consequences in the most advantageous way. Now, John Malone might not refer to it as tax avoidance for the term's association with tax evasion, which the US government frowns on / will throw you in jail for. He would most likely prefer tax deferral. In a New Yorker interview, he explained his tax deferral logic as follows. Taxes are a leakage of economic value. And to the degree it can be deferred, you get to continue to invest that component on behalf of the government. There's an old saying that the government is your partner from birth, but they don't get to come to all the meetings. This concept is a core principle of wealth accumulation, and while it is widely accepted, it's arguably frequently overlooked. The brilliant Charlie Munger has an excellent quote on this subject that explains the math in simple terms. Another very simple effect I very seldom see discussed either by investment managers or anybody else is the effect of taxes. If you're going to buy something which compounds for 30 years at 15% per annum, and you pay 135% tax at the very end, the way that works out is that after taxes, you keep 13.3% per annum. Quick pause so that we can take a look at what this means. Assume you have $1,000 invested, and that the investment grows by 15% each year. In year 30, that investment has grown to a value of $66,000. And after a one-time tax of 35%, you have $43,000, which results in an IRR of 13.3%. In contrast, if you bought the same investment, but had to pay taxes every year of 35% out of the 15% that you earned, then your return would be 15% minus 35% of 15%, or only 9.75% per year compounded. So the difference there is over 3.5%. And what 3.5% does to the numbers over long holding periods like 30 years is truly eye-opening. One more quick pause because you will likely find this surprising. Here we have the exact same investment, also growing at 15%. But we're going to pay taxes each year of 35%. In this scenario, net of tax, the investment drops in value from $43,000 to $16,000. And for the few of you worried about government tax revenue, it also works out just fine for them under scenario number 1. If you sit back for long stretches in great companies, you can get a huge edge from nothing but the way that income taxes work. Now, a difference of 3.5% may not sound like much, but over a 30-year period, it makes a considerable difference. My favorite example on this topic comes from a thought exercise provided by Jim Grant of Grant's Interest Rate Observer. Take that 200-year, 6.7% compound real return, which first electrified the reading portion of Wall Street in 1994. How would the record change if in year 201, the market fell by 50%? To provide some context, if a $100 investment achieved a 6.7% compound real return for 201 years, the value of that investment at the conclusion of year 201 would be approximately $46 million. So what would the 201-year compound real return be if the value dropped to approximately $21 million in the year 201 instead? The article continues. You suspect that a 50% drawdown would play ducks and drakes with even a 2-century performance record, and you confidently say so. But you are wrong. In fact, that seeming disaster would reduce it merely to 6.3%, a scant 40 basis points. If 40 basis points did not make your head explode, then you are either a human abacus or you are a human abacus. This is the power of compounding interest, and the reason tax-efficient structures and investment practices are deserving of your attention. If I failed to gain your interest, the last carrot I can offer is that this is likely to come up in an interview, and acting like this stuff gets you excited will help you land that cubicle residence. The notes associated with this lesson will explore both a stock and asset purchase and the tax consequences of both. And I think you will be surprised to see how legal structure and purchase type can have a drastic impact on the amount of cash that ultimately winds up in a seller's bank account. Consider, for example, the tax consequences of an asset purchase. If the target company was a C corporation, the seller would be taxed twice. First, when the assets are purchased from the company, and then a second time when the company distributes cash to shareholders. So why be taxed twice if it can be avoided? Truly hope you enjoy the full lesson and that this introduction encourages you to work through the detail. But otherwise, that's all for now. All right, team. Thanks for watching.